Good evening, everyone. Welcome to our UC Irvine Alumni Homebuyer Workshop. My name is Jason Maida. I'm going to be your host this evening. It's great to be with all of you. I know we opened up the Zoom session, so we're allowing everybody to get in and get settled in. And we'll kind of go through some kind of logistics of tonight's class, so you have that for yourself. So our runtime is just about an hour for tonight's class. It is a very interactive session. So as we go through tonight's content, really encourage you to ask questions. You can ask those questions by using the Q&A function in Zoom, and then what we'll do is we'll do our best to answer those questions on air. I know we're just over the top of the hour, so I want to allow all of our signups. We had quite a bit of registrants for tonight's class. So I want to allow you to go ahead and get into the class, and then we'll get things moving. In case you haven't heard about American Pacific Mortgage, we're a partner of UCI alumni, and we get a chance to teach classes like this 4 times a year. So this is I believe our first class that we've taught for 2024. We'll have 2 or 3 more classes throughout the year, but the timing is great for a class like this because spring has begun, and generally spring brings out home buying, so it's really an exciting time for us because there's a lot of things going on industry wide, as well as just because it's nicer weather, people are out starting to kind of looking at homes. So I think you picked a good time to kind of come to a class like this. We're going to go ahead and get started with our content. I know a lot of people are kind of rolling into the class now. I know many of us are just kind of getting off work or whatnot, but I do want to kind of keep us on track for tonight's class. In case you didn't hear my introduction again earlier, my name is Jason Maida. I'm going to be your presenter for this evening. I get a chance to teach classes like this all across the country through our different university partnerships. Of course, UCI is our favorite. I mean, it's one of our longer standing partnerships. And we actually also take some classes on campus virtually for the business school as well too. So we're really fortunate to be able to get a chance to share some of this information for you this evening. I'm based out of Northern California, but we're kind of virtually obviously hosting this class, and we work all across the country to help support our local communities and homeownership. Our emphasis is on education, so we use our educational platform to help kind of teach the next generation of first-time buyers what it could look like for you to purchase a home, so you can better understand your resources, all the support you have with you on this journey towards homeownership. All right, so for tonight's class, as I mentioned earlier, it's very interactive. So if you have a question while I'm rolling through the content, please use the Q&A function. I'll do my best to answer those questions on air. One of the things we're doing a little bit different with our classes, which is kind of asking our audience where you're joining us from. So if you get a quick minute, type in the chat where you're joining us from, because a lot of my presentation material will be kind of focused on the LA and Orange County market, but I'd love to get a sense of where everybody's joining us from. So if you can, just drop it in the chat, and we can get a sense of where you're at, because obviously in the housing industry, home prices and the general cost of living varies by where you're thinking about purchasing. And some of us might be out of California too, and that's totally okay. But we're going to be talking about some market data in just a bit. So thanks for putting that in the chat. I appreciate that. A lot of us from Irvine. See Sacramento representing, Norwalk, awesome. Orange County, Riverside, very cool. Thanks for doing that. I appreciate that. So that kind of helps give me a sense of where our audience is at. Here's our talking points for tonight. We're going to look at the housing market in just a bit. But before we do that, we're going to do a budgeting exercise where I'm going to walk you through kind of a what if scenario of looking at renting versus buying and what that could look like for you as a future first-time home buyer. We're going to do some housing market looks at kind of what's going on with the housing market, but also oops, sorry, I got a little chime going off there. Sorry about that, audience. We have a fire. We ever had this in one of our classes? This is not a good timing. So we have some fire alarm tests apparently going on in our downtown building. So hopefully that doesn't impact us. If it does go off, what I will do is I'll mute us out so you guys don't have to deal with that, which is unexpected. So thanks for dealing with that. I'm gonna mute us out for just a second, guys, so you don't have to hear the loudspeaker. Okay, so hold on for 1 second. Okay, we're back. I apologize for that. We'll see if we do get any interference with noises here in our building. I'll definitely mute us out, but I'll make sure we keep us on track. So thanks for dealing with us on that. This is a unique experience. So going back to our agenda for tonight, after we move away from the kind of the market data, we're going to spend some time looking at credit, how we can help improve our credit as we go down this path towards homeownership. We'll talk about student loans, various loan programs that are available to you, some of the documentation for income qualifying, various assistance programs that exist for you and it looks like most of us are in California. So I'll spend some time looking at some of the California specific programs. And then we'll wrap up tonight's discussion looking at the buying process. So if I kind of leave tonight's class and I think, hey, you know what? I think I want to learn a little bit more about home ownership. We're going to show you about the steps to take in that journey towards reaching your home buying goals. All right. All right, let's go ahead and keep it moving. Then I promised you we'd start by looking at a budgeting exercise. But before I do, I want us to kind of shift our mindset a little bit. So when we think a little bit about home buying, it's certainly a lot different than renting, right? Because we're not thinking about how the landlord's going to increase rents on us over time. We're trying to invest in an asset that would hopefully appreciate over time. So when we think about the benefits of owning a home, we're creating hopefully stability with our budget and household debt or household expenses, I should say. The home, as it appreciates in value and as we pay down our mortgage, that separation between those numbers creates equity in our home, and that creates generational wealth, hopefully, for us. This is an asset that does pass down to generations in our household, and there still is some really good tax benefits that come along with owning a home. So as we get on that path towards home ownership, I think it's really helpful, like I talked about, to kind of help talk more about a budget for home ownership. Because as I tell classes that I teach across our markets we support, is that it's not necessarily an apples to apples comparison when you think about home ownership versus renting. So when we do a budget exercise like we're going to do right now, we want to factor all the great benefits that come along with owning a home. Now, my job here is not to convince us to purchase a home or not. It's just to give you all the facts and all the ingredients that we should probably think through when it comes to owning a home. So let's look at this calculator and we're going to kind of walk ourselves through it and kind of see what it could look like for us. So this calculator, by the way, is on the Freddie Mac website. So we're going to send you all of the presentation material after tonight's class. So we'll have all the links available to you that you can do in your own exercise and budgeting. But I thought I would kind of share this with our audience so you can get a sense of how you would kind of think more through the comparison of buying versus renting. So let's say we have, a rental amount of $3,000. We're assuming a renter insurance of $15. And then we're going to make the assumption that rent will go up about 5% on an annualized basis. Now, from a purchase price perspective, I'm going to change this a little bit. I'm going to adjust this up a little bit. I know many of us are in higher cost of living markets, so bear with us for this exercise. But what we're going to do is we're going to look at it at a $600,000 sales price. Okay. Now I know that's going to look a lot different, especially I know many of you guys are joining us from Irvine, which that might be really difficult if you're looking to purchase in those markets. But this will just kind of give you a little bit of a baseline to think through this calculator. So you have a $600,000 purchase price. You have a minimum down payment of 3%, which would be a conventional product, which we're going to learn about in just a bit. You have your property taxes of owning a home, homeowners insurance, the maintenance costs of owning a home. So we want to factor that all into this equation. And then we're going to have our loan information. So generally, as first-time home buyers, we're going to elect a 30-year fixed mortgage. So it's fixed payments over 30 years. We have an average interest rate. We're going to talk about interest rates in just a bit. And then we have origination charges. Those are costs that you're going to pay in obtaining your financing. Now, one of the great things we have with our partnership with UCI alumni is we actually discount our services by $750 because of our partnership. So you'll be able to participate in that as well in your financing solutions with us. Then you also have discount points. Now, discount points give you the opportunity as a buyer to pay additional costs out of pocket that can help bring down your interest rate. Generally, 1 point is the equivalent of 1% of my loan amount, which will help bring down my interest rate about 0.25%. Okay. Today's market, which we're going to talk a little bit about interest rates in just a bit, interest rates inched up about a 0.125 level. So, that's not significant, but it certainly changes some of the buying power for some of our clients. Now, we're really watching interest rates really carefully, and we're going to talk about interest rates in just a second. But you do have the option as a consumer to help bring down that interest rate by increasing your out-of-pocket expense. And then there's other settlement services or costs. Those are what we call closing costs as part of a home purchase. When we think about budgeting for home buying, we generally want to set aside at least 2 to 3% of our purchase price in funds that we can use towards our closing costs. Now that does vary by based upon what you negotiate with the seller, but the rule of thumb is about 2 to 3% of our purchase price. And then we have our appreciation rate of our home. So we're thinking our home will appreciate about 4% annually over the course of 7 years of being in the house. The selling cost of our home, we have the state and federal tax rate, as well as what we would compare in a savings rate for like a high yield savings account. So what our calculator comes back to us, it says, okay, so if we are accustomed to paying $3,000 a month in rent, we're thinking about home ownership, we're going to have to prepare ourselves for our budget going up to $5,000 a month. So that's a $2,000 increase. But our trade-off of owning versus buying over the course of a 7-year comparison is about a $92,000 upside in owning versus renting. Now, that's going to look a little bit different for all of us in tonight's class, but it gives you kind of a little bit of a sense of how we should be thinking through home buying, because like I said earlier, it's not necessarily an apples to apples comparison, because we want to factor in things like tax savings, appreciation rate, clearly owning an asset that will hopefully grow over time and ideally obviously create generational wealth for yourself. So that's kind of how we launch into our class, is usually kind of sitting, kind of sifting through a little bit of a budgeting exercise. Now, the other thing we want to think about in home buying is what are home values doing, right? So, for those of us in the California market, which is most of us in tonight's class, we're obviously in a more of a high cost of living market. Some have higher cost of living areas than others. I know somebody joining us from San Jose, or if we're in the Irvine market, those are super expensive markets right now. But I think when we look at those markets, they all kind of face the same challenges. Of course, they are much more expensive, but we still have limited inventory in the market and still relatively strong demand. So it's starting to push prices up even further. You can see that kind of displayed here in our slide, where home prices are inching closer to the $900,000 median level in the Orange County market. Prices might look different in, say, Sacramento, but that same trajectory of home prices looks very similar. We are expecting about a 10% lift or increase in inventory that's available in the spring and summer buying months. So that's an encouraging sign. If rates come down a little bit, that probably will lead to higher buyer activity, which will, of course, will lead to higher home prices. So, that's going to be kind of a balancing act a little bit, especially for buyers that are looking to enter the market in 2024, maybe to a certain extent 2025 as well. The thought is, from a rate perspective, and today wasn't a good display of that, but rates will start to trim down over the course of 2024. There was thoughts before today that rates would come down at the June meeting that the Federal Reserve has. However, inflation numbers came in a little bit higher than we expected. There's a report called the CPI report, which is a consumer price index report. That was about 0.1 higher than we expected. So rates actually inched a little bit higher today. Hopefully we'll see a little bit of recovery. When we look at the interest rate kind of environment, it is very hinged on what's going on with inflationary reports. We had some good indicators come ahead of that report, but then we got the CPI report today. It looked a little bit different, so it kind of really took the markets by surprise. And so now it's a little bit of an unknown if the Federal Reserve will cut interest rates in June. So it's kind of a to be determined type of situation. I want to show you what interest rates look like over the last 12 months, because we've obviously made some strides as we compare rates to what we saw in October. So October 21st, rates hit 8%. Obviously changed the buying climate for many of our buyers. But shortly thereafter, we did see rates start to decline. Now we're still at historical highs. An average interest rate historically is about 5.25% to 5.5%. We're still above that. Today, we're probably right around the 6.7 to 6.8 range. So that's kind of where we sit today. Hopefully we'll see, or be in a place that we'll see interest rates start to kind of pull down a little bit as we move into the latter part of 2024. The hope is that we can get to sub 6% in 2025. But obviously, inflation is going to be what's going to be the measuring stick of where interest rates go. The goal for the Federal Reserve is to get inflation to 2%. I think today we're at 3.1, if I think that's the right number. So we're still a long ways away from that goal, but there was expectation that we would probably see 3 Federal Reserve rate cuts this year. So, hopefully that still will be the case. But obviously today's report looked a little bit different than we expected. We had a question in the chat, and I'll kind of just comment on this, which is being able to, for us to, as a class, to be able to review different buying strategies between buying when rates are low and then when prices are higher. What's that need to look like for us as buyers? I mean, is there different ways that we should think about that? So I'm going to kind of just give you a general analysis of that. And, the first thing is, most people want to buy the lowest priced home and the lowest price rates, but that's not the perfect storm that's going to occur with the housing industry. It just doesn't happen. So when, everybody was excited about 2.5% rates 2 years ago, we're obviously going through a horrible time in our global environment, but home prices were also ticking up too as interest rates were at those lows. When we think about home prices at higher levels, and interest rates are lower, there obviously is demand that's pushing that up. If you're trying to enter the market, your entry point looks a little bit different for everyone. I think ultimately, when you think about buying in today's market, it's probably going to be more of a short-term play. And here's what I mean by that. If we can get in today's market, generally most of our clients who are thinking about their budget today, hopefully you're going to have the opportunity to refinance in 2 or 3 years down the road. So if we can get in today's market before prices rise, then that creates an opportunity for us to secure a home price at a lower level and then hopefully refinance down the road if there's an opportunity. Okay. And refinancing, just to clarify for our class, refinancing means that I'm electing a lower interest rate because the market is supporting that by taking my existing first mortgage balance and now financing at a lower rate to help lower my monthly payment. Okay. All right. That's a good question. I appreciate that. Let's talk a little bit about interest rates. There's various characteristics that go into interest rates. There's credit eligibility. So the higher my credit score is, that's going to help improve my interest rate offering, the type of loan product that I have, how much I decide to finance, what my down payment is. So if I put down 3% versus 20%, my interest rate will look a little bit different. We talked a little bit about discount points where I can pay additional costs to help lower my interest rate. Just a kind of a quick look back to that. As a reminder, 1 point of your loan amount is 1%, or discount point of 1 point is 1% of your loan amount. It will generally lower your rate on average about 0.25% for the start rate. And that's for the duration of the loan. And then the term of the loan can also influence my interest rate. So if I take a shorter term of my loan, maybe moving from a 30-year fixed mortgage to a 15-year fixed mortgage, that could potentially lower my interest rate. In today's market, that doesn't necessarily coincide with what we're seeing today, because we're in an inverted yield curve right now where long-term rates are intersecting short-term rates. So shorter term rates don't necessarily benefit us from a rate perspective, but certainly it raises your payment the shorter you have to pay back your loan. But as we meet with our clients, it's our job to kind of create a home buying plan for you that works for you and helps you accomplish your goals and objectives with home ownership. Now, credit's a major role it plays into our interest rate, right? And as I work with hundreds of clients throughout the year, there's usually 2 challenges to home ownership. It could be credit, because we're not positioned correctly with our credit. Maybe we're overextended or we haven't established credit yet, or it could be savings for down payment and closing costs. We'll talk a little bit about savings and down payment later on, but let's kind of focus in on credit. And I think it's helpful as buyers to understand what goes into the mortgage credit score calculation. There's actually 3 different credit scorecards for scoring of credit. There's the credit card model, there's the auto model, and there's the mortgage finance model. So of course, in home financing, we're looking at the mortgage model. If you're monitoring your credit, like through Credit Karma or some of the agency products, those are using the credit card model. So, if I'm a 680 today on a credit card model, it might look a little bit different on the mortgage model. So let's look at the weighting of the mortgage model. So 15% is going to be how long have I had credit. So the more mature my credit file is, the higher my credit score could potentially be. 20% is going to be how much new credit do I have in use that I'm trying to obtain? Like how many new accounts am I opening? Do I have inquiries on my credit, like hard inquiries? Those are going to be 20% of the weighting. Now, starting our process with our team, we only start with a soft credit check. And the reason why we do that is because many of our buyers may not be buying this year, maybe not even next year, but we want to give them a roadmap for home ownership. So we don't want to have them impacted from an inquiry perspective. So that's why we always start with a soft credit check, which seems to be really useful for our clients. 30% is going to be my credit utilization. So we're going to spotlight revolving accounts under utilization. So For example, if I have $10,000 in credit limits, my balances are $5,000. That means I'm at 50% utilization. The optimal level to keep my credit balances at would be at 10% utilization or less. Now, if I'm at a higher utilization level at 80 or 90%, I want to do my best to try to first work below 50% utilization. Once I've kind of got my balances at that level, now let's try to push towards like a 10% utilization to get our optimal credit score available to us. Now, let me give you a quick tip to kind of help better manage utilization and optimize credit score. If you have some time in the next day or so, take a look at your most recent credit card statement. There's two key dates on that statement. There's a billing cycle date, there's a due date. The billing cycle date is the date at which the creditor issuer sends out all the data to the agencies. And those three agencies are TransUnion, Equifax, and Experian. Well, when they send out that data, that's what gets reported to the reports. That's what's gonna influence your credit score, right? Now, if you're in the habit of paying on your due date, there's nothing wrong with that. But what you're missing there is you're not getting that balance that's been paid down because it's not falling within the billing cycle date. So if you can change your payment timing to pay off or pay down those balances before the end of the billing cycle date, then you'll get a much more improved credit score, hopefully change some of your interest rate options, maybe your program qualifying. So that's a better way to kind of manage utilization of credit. The last component to the credit model for mortgage is going to be payment history. So that's 35% of the weighting. That's how I've paid my bills, right? If you've had some past late payments, they'll be rated as 30-day lates, 60-day lates, and 90-day delinquencies. We're really looking at late payments in the last 12 to 24 months. Those are going to be the biggest impact to your credit score. Okay. And so that's kind of what the mortgage model looks like. Now, when we look at kind of the overall kind of credit history and then how it's impacting qualifying, like I said earlier, we're looking at the last 12 to 24 months of kind of maybe events that you've had on your credit report. Bigger events like bankruptcy, short sales, collections, those are going to have a bigger impact on your credit score. And the more severe my late payment is, the bigger impact I could have to my credit score. One thing I want to kind of point out to the class is that when we look at closing accounts like revolving accounts, you want to be careful of that because when you close out a revolving account, it actually pulls away all the history from the credit bureau. So if I've had an account for 10 years and I close it out because I do a balance transfer, I'm now losing 10 years of history on my bureau. Also, it takes away another line of credit in the aggregate totals for your revolving utilization. So just be careful of that when you're kind of managing your credit balances or closing out accounts that you don't really use. On the qualifying side for mortgages, now we know there's 3 different scores, right? Well, from a mortgage perspective, we take the middle score of all 3 bureaus. So here's what I mean by that. If you have a high score of 760, your middle score is 740, and your lowest score is 720, we're going to take the middle score, which is 740 for qualifying purposes. Now, if I'm playing jointly with my spouse or a partner, we take the lowest middle score of both reports. So if my partner's at 720, 700, and 680, the 700 score is going to be used for qualifying purposes. Okay, and that's really important to understand because that may influence my product, my interest rate, maybe even mortgage insurance when it comes to our qualifying. So if you've had other negative events on your credit report, this is a matrix that'll show you how long they've been on your credit, or how long they will stay on your credit report. So late payments will be like 7 years. If it's public records, those will last a little bit longer, like 10 years. And any type of federal tax liens or something like that, those can be on your credit report indefinitely. One of the credit items that we come across in working with our buyers is obviously student loans, right? So student loans are, for the most part, in repayment for most federal student loan debts. Now, for the most part, most student loans are reporting the minimum credit report on the reporting that we use from a financing perspective, but at times it doesn't. If you're in an income-based repayment solution for your student loans, that's the payment that we can use from a qualifying perspective. Now, if you're back in school and you're in a forbearance or you have a deferment on your student loan payments, we do have to still count a minimum payment for qualifying purposes. That payment will generally be the equivalent of 1% of my balance if I'm doing a conventional product. If I'm doing an FHA loan, it's 0.5% of my overall balances. It's more beneficial to use the IBR payment option because obviously that should give us the lowest payment, as you can see on our example on screen. So like we have here, if you have a $75,000 in balances, but my IBR payment's $250, that $250 payment is what we can use from a qualifying perspective. So again, if you're in forbearance or deferment, we understand that you're not going to be making payments actively right now, but we still have to count a minimum payment for qualifying. All right. Questions so far from our class of anything that I've covered so far? Okay. Okay, and I know we had our announcement that went on. We kicked off class. There are alarms going in the background, so hopefully you guys can't hear them. They're pretty faint back there, but yeah, nice time for our building to do alarm inspections tonight. But hopefully it's not distracting for you as a class. But please let me know in the chat if it is, and if it's messing up the audio, we'll definitely try to figure out a workaround. So let's talk a little bit about loan programs now, and we're gonna, and actually before I go into that, I just did get a question that I want to kind of answer. And the question is, there's a minimum payment on credit cards that you have to pay on a monthly basis. How does that affect your credit? So if you're paying the minimum payments, as long as you're paying those payments on time, then it's an on-time payment. It doesn't change anything. Usually your credit card company is going to charge you 2 to 3% of the balance as a minimum payment. Obviously, I would encourage you to pay more than the minimum because those payments can go on forever. If you pay minimum, try to accelerate, those payments as much as possible to help improve your positioning for utilization and obviously get your credit score lifted. So yeah, but the minimum payment, whether you pay more or less, doesn't change anything. Let's talk a little bit about loan programs. And so these are kind of the core loan programs that we offer. So there's the conventional product, which is a Fannie Mae and Freddie Mac loan. You guys may have heard that kind of term out there. Generally speaking, those products have a minimum down payment of 3%. Now, if we're in high cost of living areas like San Jose or Irvine, maybe even Sacramento for that matter, if you go beyond a loan amount of 766,550, the minimum payment jumps from 3% to 5%. So that's called a high balance loan. And so those are going to help support some of our areas that are a little bit more expensive to still allow buyers access to purchase in those communities, but with a lesser down payment. But the minimum down payment as a first-time buyer up to 766 is 3%. Higher limits will go up to 5%. So that's for the Fannie Mae and Freddie Mac loan. FHA loans. FHA stands for the Federal Housing Administration. That is a federal loan, so it is completely government insured. Minimum down payment of 3.5%, up to loan amounts of $1,149,825. Regardless of those loan amount tiers, the minimum down payment is 3.5%. So when we look at FHA, they kind of break down the loan amount by county. So if you're interested in the FHA product in this particular area, we obviously have a minimum loan amount, or maximum loan amount, I should say, by that particular area. FHA is going to allow a little more flexibility from a qualifying perspective than a conventional loan. You saw in our credit section that the minimum credit score on an FHA loan is 580, where it's 620 on a conventional loan. The FHA is also going to have a lot more flexibility when it comes to maybe past late payments in the last 12 to 24 months. Or let's say I had a bankruptcy that was 3 years ago. FHA would be completely lenient and allow me to get financing with that type of situation. Whereas conventional loans, I would need at least 4 years out of the bankruptcy to qualify in a conventional product. And then for our veterans that have eligibility for the VA home loan program, which is an amazing product, you have a 0 down payment option. And that goes up to really no maximum loan amount. The veterans have eligibility through a certificate of eligibility. If we have any veterans here in tonight's class, that's a product that can also work with first-time homebuyer programs as well. So it's a minimum credit score of 620 for the veterans loan product, and that can be used across all markets across the country. I had a question that was in the chat about PMI. I'm going to talk about PMI. We have a separate section for that, so just hang tight on that. I'm going to walk you guys through kind of a PMI situation in just a second. The other two products I want to spotlight are the USDA product. USDA is for clients that are going to purchase in rural areas. There's two qualifiers for USDA. There's an income qualifier for the household income. There's also geography because it is designed to support rural communities with financing. And then the jumbo loan product are for clients that need a little bit more financing support than maybe Fannie Mae or FHA can support. Now the other side of that is the jumbo product does have a minimum down payment of 10 to 15%. and there's additional assets required, like reserve requirements. So generally when you purchase a home, and we're going to talk about more about this later, you have to save for your down payment plus your closing costs, which we learned were about 2 to 3% of our sales price. But jumbo loans require additional reserves, which generally will be about 12 months of my monthly payment. So if my monthly payment's $8,000 a month times 12, I would need an additional $96,000 in reserves. All right. So those are some of the main products that we kind of focus in for some of our buyers. Now, in financing, when we put less than 20% down, there's what we call as PMI, or private mortgage insurance. I know we had a question in the chat about this. So we're going to kind of do a deeper dive into PMI. And I think let's first kind of understand what is PMI, because I think there's a little bit of confusion around that. PMI is insurance that ultimately protects the lender when clients are buying homes and putting less than 20% down on a conventional loan, and for clients that are using FHA products. Conventional loan is a private mortgage insurance, so it's financed through private companies. There's a variety of different ones that are out there. FHA is a government insured product, so it looks a little bit different, so it's federally insured. So let's look at first the conventional product. So the PMI does come into place on a conventional loan if I put less than 20% down. There's different payment options that you can make with PMI on a conventional loan. There's monthly options, which is the most popular option because it has a cancellation component. There's a split MI where I can pay some of it monthly, some of it up front. There's a single premium where I can basically buy out the mortgage insurance. And there's also lender paid mortgage insurance where I basically elevate my interest rate to buy out my mortgage insurance. Again, the most popular option is monthly mortgage insurance because I do have a cancellation option for MI, which says that when I have 2 years in this original loan and 20 to 22% equity, I can apply to have my mortgage insurance canceled. Now, there's different factors that go into the PMI calculation of your premium. There's things like credit score, down payment, amount financed. Those all go into the equation of what my premium is going to be for PMI. Now, when we look at a PMI example, and we have it kind of at the bottom of the screen here, probably looks a little bit different than maybe what some of you guys have seen on Redfin or Zillow if you've already kind of started some of your home searching, because they don't have their calculators calibrated to what the actual characteristics that go into mortgage insurance. So if I bought a home and I financed, let's see, $700,000 and I had a 740 credit score and I was putting 3% down, my PMI is about just over $200 a month, right? So some of those calculators you use online might show up much higher monthly premium, maybe closer to $300 or $400 a month. So the higher I can push my credit score, the more I can put down, that mortgage insurance should hopefully decrease accordingly. FHA mortgage insurance is not going to work the same because it is based upon kind of just the product. So whether I'm a 580 credit score or I'm a 780 credit score, if I elect the FHA product, I'm going to have a kind of a fixed mortgage insurance premium. Now, there's two mortgage insurance premiums to FHA. There's upfront mortgage insurance, which is going to be 1.75% of my total loan amount. There's also a monthly MI factor, which is 0.55% of my total loan amount, and then we divide that by 12, and that's how we come up with a monthly figure. Now, there is no cancellation option on FHA mortgage insurance like we do on conventional products. The only way to get out of FHA mortgage insurance is if I was to refinance out of the product. So if we take the same loan amount, let's say $700,000 for the FHA side, now we have to add on the upfront mortgage insurance of 1.75%, which is $12,250. And then we have the monthly mortgage insurance of $320. Now we can, obviously there's a bit of a difference there between FHA and conventional, and expenses look heavier on the FHA side. However, I think it's important to understand as buyers, not all clients will qualify in conventional. So FHA can be a really good alternative, especially if I've had some, late challenges on my bills, or maybe I have an event that just doesn't qualify me in conventional. We can still look at FHA as an alternative. Now, one of the things I do hear from clients, because especially if you decide to Google rates right now, FHA rates will show lower than conventional rates for the most part. But I think it's important to understand that that's not the whole story when it comes to interest rates, because as you're learning tonight, the mortgage insurance is a little more heavily loaded on FHA versus what it is on conventional. So you may see a 6.5% rate on FHA and a 7% rate on conventional, but there's more to the story in that you have to think through the different expenses, like the mortgage insurance is more expensive on the FHA loan versus a conventional loan. So a question we had, which is some real estate listings advertise FHA eligible. What does it mean? So the reason why they're saying that is because some properties may not qualify under FHA because of the condition of the property. So they may have some particular issues that may not be compliant with an FHA loan. So we haven't talked a little bit about this, but on the FHA product, the appraisal requirement can be slightly more strict than the conventional product. So that's where, some properties may not qualify. If you're going to use FHA to purchase a condo, that can be a little bit challenging because a majority of associations that are affiliated with condo developments are not qualified under FHA, but it's kind of a case by case situation. We had a question in the chat about the slideshow being shared. Yes, sorry, and I probably should have. We had a little bit of a distraction before we launched it in tonight's class, but everything's being recorded tonight. We'll have everything up on our YouTube channel tomorrow, and all of our registrants for tonight's class, we will send over the presentation material. Yeah. Let's talk a little bit about documentation that we want to gather from an income perspective in qualifying for financing. So generally speaking, we need the last 2 years of W-2s, the last 30 to 60 days of pay stubs. If I'm self-employed, I need the last 2 years of tax returns included in that. And then from an asset perspective, I need to verify at least 2 months of bank statements that we'll kind of use to verify assets. We're going to talk about assets just in a second. I do want to spend a little bit of time talking more about qualifying income as it relates to employment, because there's rules out there that I think get misinterpreted a little bit in that, there's a 2-year rule in place on financing, but I want to kind of define for you the 2-year rule. The 2-year rule basically means that I need to have employment and or education for the last 2 years to be able to qualify for financing. And that could mean that I've been on my job for 1 month and it's maybe an accounting job and I just got my accounting degree from UCI in the fall. That would qualify for 2 years. So I could use my 4 years of undergrad plus my new job to help qualify me for my financing. In some cases, I could be switching over to a new job, and as long as I have that 2-year history behind me, I can still qualify with my new wages on my new job. So sometimes I hear from clients that they've been told that they have to be on their job for 2 years, and that's not the case. You have to have a 2-year work history and or educational history. Where it gets a little bit more challenging is if I have dual employment. So some of our clients may work for multiple employers. In that case, if I do want to use both streams of income, then I have to show that I've been working on both jobs for 2 years. The 2-year rule is really important for our self-employed clients. So if I do own a business or I'm a 1099 independent contractor, I do have to show that I've been doing my job or have my business for at least 2 years. The other kind of where that 2-year rule is really important to understand is if I'm working less than a full-time schedule, so it's a part-time work, if I do want to show my part-time income, that's where the 2-year rule would be in place. I have to show that I have consistent hours for 2 years. And the reason why that is because if there's variability to any source of income, even things like bonuses and overtime income, we have to show a track record of receiving that income, and there's no way to measure that unless we can see it in kind of a wider snapshot, which would be generally a 2-year look at things. So, if you are with your employer for at least 2 years and you have a bonus component to your comp plan, as long as I can see that you've been on that job for 2 years and you have 2 years of receiving bonuses, we can use those into the qualifying. All right. Got a couple questions in the chat I want to kind of highlight, and then I'm going to kind of go over a couple things, and then we're going to move into some other income items. So the question is, if I want to buy a home within the USDA map, do I still have to work with a standard loan officer? So to get access to USDA loans, you have to work with a USDA approved lender. So APM, we're an approved USDA lender. So the answer is yes, you do have to work with a qualified USDA lender. CalHFA, which you're going to learn about just in a bit, which is a first-time buyer assistance program, also works with the USDA program if you're looking for assistance to also complement your USDA product. Another question is, what is the maximum amount of employment/education gap to make someone not qualify for the 2-year requirement? So there's no kind of stated gap time that we have to limit it to. We just have to justify the 2-year rule. So meaning that we have to show a 2-year work history and or education. if you've had a gap, we just have to better understand why that was. Coming out of the pandemic, obviously there were a lot of people that were unemployed. So obviously we can kind of justify that or validate that pretty easily because, there's a lot of people that are displaced. Um, okay, great questions. And then question was about gifts towards down payment. Let me table that one. I'm going to talk about assets in just a bit. We have a full gift section that we'll go through. Last thing I wanted to just highlight on the verification process for employment is if you have a full-time 40-hour work week job and then you're maybe working for or driving for Uber or Lyft on the side, if you want to include the Uber/Lyft income, we do have to show that you've been doing that simultaneously 2 years with your 40-hour work week job. Okay, so in financing, there's a calculation called debt to income ratio, which is taking your pre-tax income versus your monthly expenses, including the new mortgage. Really simple calculation that we use. It's a calculation that we use for qualifying, but it's not necessarily an affordability metric. In affordability, we're gonna have a conversation with you about kind of what feels right for your eligibility, not necessarily qualifying. But we're going to look at debt to income ratio to make sure that works. Obviously, with the cost of everything nowadays with affordability or the cost of inflation, we get how things are expensive but we still have to make sure that we hit certain metric goals in debt to income ratio. And what that calculation looks like is this. It's your principal and interest for your loan, the property taxes and insurance for the new house. And then if I'm putting less than 20% down, we have to factor in the private mortgage insurance or, FHA insurance. And if I'm buying a HOA type property, condo, townhouse, we want to bake that into the payment amount. And then I'll take my other expenses like my personal loan or my student loans, my car payments, credit cards. We factor that all in, minimum credit card payments versus what our gross monthly income is. And that's how we kind of factor out this this equation here, right? So a client that had 33,000 expenses, $8,500 in debt, their debt to income ratio is 35.29%. So that's what we're looking at. Generally speaking, lenders, we cannot have that debt to income ratio exceed more than 45 to 50%. And for our clients, we get, questions about what should I be at? And, it varies for different clients. Everybody has kind of a different tolerance level when it comes to debt to income ratio. As a rule of thumb, I think the comfort zone, is around 33 to 36% in working with our clients that I do. So from an asset perspective, that's our last component to the home buying plan, right? I mentioned earlier that we have to save up for our down payment and our closing costs. There's documentation that we need in that process. And usually we're gonna have to verify the last 60 days of assets, things like checking and savings accounts. Retirement accounts can potentially be used. I would encourage you to talk to your financial or tax advisor before you access those assets because it could impact you from a tax perspective. We had a question in the chat about gift funds, and gift funds are where a family member is going to contribute to your home purchase. Those funds do not need to be seasoned. There's a documentation process for that. Generally, we need a gift letter, which we would provide as your lender, and then we verify that the donor is sending the money directly to escrow, or they have to verify the money coming out of their account. But those funds do not need to be a season, like I said, but they can't be cash gifts. They all have to be documented through a paper trail process. Now, when we think about down payment, it is that second challenge that we have for clients in home buying. I talk a lot with buyers about home savings plans. So if we have a 2 or 3 year goal to purchase a home, one thing you can think about to help kind of build savings is to develop a budget for home buying. And here's what I mean by that. If you're currently paying, let's say $1,500 a month in rent, but you think as you were to fast forward to home ownership and you can afford $3,000 a month, right? That's $1,500 that you have in capacity in your budget. What I would encourage you to do is start paying yourself like you're making a mortgage payment right now. And instead of making that mortgage payment, you're paying yourself into your savings account an additional $1,500 a month. And before you know it, in 6 months, now you've accrued almost $9,000 in savings. And I think that's a great kind of just a basic approach to helping grow your savings because it is a challenge for home ownership. I mean, not everybody's fortunate to have gift funds from family or to have, a really good nest egg for home ownership. So a savings plan like that can be a great way to kind of jumpstart your path towards home ownership. Now, in solving for savings and getting resources around first-time home buying, there's some phenomenal programs that are available to you, especially in the state of California. So we partner with an agency called CalHFA, which is the California Housing Finance Agency. It's designed to help support low to moderate income household buyers across California. There's a variety of different programs that are out there. One program that's got a lot of spotlight right now in the last, 30 days is a program called Dream for All, California Dream for All program. Provides up to 20% of your sales price in assistance or $150,000, whichever is less. We've been inundated with inquiries. We've taken over probably 3,000 inquiries on that program, which is a really exciting option for clients. But you do have to be a first generational buyer for that particular program. And here's what first generation means. It basically means that I have not owned in the last 7 years and that my parents are not currently owners in the US. And that's a phenomenal product. And only one of the buyers has to be first generational. So if I'm applying with a spouse or a partner, as long as I have first generation qualifying, then we could both be eligible to participate in a program like that. That program registration is available now. It is a lottery-based program, and it's about a 9% acceptance rate right now. So we will have lottery results on that in early to mid-May. If that's something you're interested in, there's still time to register for that program. On our YouTube channel, which you'll be able to check out after tonight's class, we have an hour-long class on shared appreciation. Would encourage you to check that out. We don't have a lot of time to go into that product in depth tonight, but that's a really great resource that's out there for eligible buyers. Now, that's a once-a-year type product. It may be available in 2025. We just don't know what that looks like now. But what's always available is the MyHome and ZIP assistance programs. Those are standard programs with CalHFA. They provide up to 3% of your sales price in assistance for a conventional loan, 3.5% for an FHA loan. And what the state is providing you there is a simple interest loan at 1% that does not need to be repaid until you either sell your home or if you decide to refinance in the future. Okay, it's a really great tool, always available through CalHFA. And the rates are really competitive on these programs. They generally are about 0.25% below market rate. There's also a closing cost assistance program called ZIP Assistance that provides up to 2 to 3% of your purchase price in assistance. That is kind of an add-on to MyHome if clients want to take advantage of that. ZIP Assistance is a little challenging in today's market because with interest rates being a little higher, it does elevate the mortgage interest rate on the first mortgage about a full 1%. So not as appealing as it was once, when rates were in the 2.5 to 3% range. Here's a scenario of home buying that I think would be helpful for you guys in tonight's class. So if we took that $700,000 purchase price that we talked about a few times tonight, generally I'm going to need to put down 3% like we talked about, which would be $21,000 plus closing costs. So if I was to buy today, I probably need to have on hand about $35,000 to $42,000. That's just the reality, right? Now, if I was to substitute in the My Home Assistance program that CalHFA offers, I can get $21,000 in assistance to help bring down my cash out of pocket. So maybe instead of the $35,000 to $42,000, maybe that number's $14,000 to $28,000. And that might be a little bit more attainable as a near-term goal for us. There's also the option, of course, to add on the ZIP assistance if it also makes sense for you too. So that's a great way to help kind of augment your options for home buying to make it a much more attainable option for you. Now, CalHFA does have eligibility requirements. It's a minimum credit score of 640 for an FHA loan, 680 for the conventional product. By the way, the conventional product is the only product that works with the Dream for All program. If you're considered low-income housing and you make less than 80% of the median income, then it's a minimum credit score of 660. And one of the cool things about this product is the income qualifications, which you're going to see the limits in just a second. They're based upon the applicant income, not the household income. So that can allow a lot more buyers to get access to these programs. And it's designed to help first-time buyers. So the definition of a first-time buyer is someone that hasn't owned in the last 3 years. And these products are good for properties such as single-family homes, townhouses, condos, some manufactured homes if they're on land that is owned by the potential buyer. Here's the income limits for CalHFA. So on the left side is your My Home Assistance Program guidelines, which they're equivalent of about 150% of the median income for those respective markets. The other side is the Dream for All Assistance Program income limits, which is about 120% of the median income. So again, reminder on those income limits, It is just based upon the applicant's income, not the total household income. So in some cases, especially with Dream for All, if I'm buying in Orange County and I make 150,000 and my spouse makes 150,000, if I can qualify for the program or property that I'm looking for with Dream for All, I could qualify with just my income and still be eligible as a first generational buyer. Question in the chat, which was, can the veterans combine the VA loan with down payment assistance programs? Absolutely. So CalHFA does have a VA product option as well. So you can use your 100% VA loan option. Then you can add on the 3% MyHome assistance. Take advantage of that assistance to help lower your total out-of-pocket expenses for things like closing costs. So great question. You got it. No problem. Any other questions on CalHFA? I know I gave you a lot. I mean, we have hour-long classes devoted just to CalHFA. Again, check that out on our YouTube channel. There's a lot of good information there for both the Dream for All product as well as MyHome and ZIP. You guys can take some time or just to kind of listen back to some of our other previous recordings. Let's now talk a little bit about the buying process. I want to walk you guys through the milestones of buying. So after tonight's class, you may say, hey, you know what? I want to design a home buying plan with you, Jason, and kind of figure out what that looks like. Let me walk you through the milestones of what buying looks like. And we call that our 6 steps of home buying. Let me answer this quick question in the chat for the group, and then we'll go through the milestones. The question was max loan amount for CalHFA. The maximum loan amount follows those Fannie Mae and FHA loan limits. So if you're in Irvine, the maximum loan amount is the 1149 number. Okay. All right, so let's talk about the home buying process. So the first step on our journey towards home ownership, well, is a consultation. That's a one-on-one with me. It's usually a 30-minute session. We're doing some express sessions right now for the Dream for All program just because of the demand for the timeline constraints. But generally, you'll be meeting with me for 30 minutes to design a home buying plan. And then the output of that session is to issue a pre-approval. And that is to show you the product that you're eligible. The pre-approval is going to be a certificate really that you're going to present to a seller that shows that you're eligible for financing to make an offer on their place. Now, generally that pre-approval is good for 60 days, but for a lot of our buyers, it takes a little bit longer to purchase a home. So we can always recertify that pre-approval. Now, once you're pre-approved, then you should start going out and doing some house hunting and kind of just checking things out online. Maybe it's getting in the car and going actually physically looking at homes. Regardless of how you take those next steps, we would encourage you to partner with a realtor. Those realtors should be an expert in their market that you work with. We do have preferred realtors that we work with across California. So whether you're looking to buy in Irvine, San Jose, Sacramento, Fresno, we do have preferred realtors that we work with. And we would encourage you to take advantage of those type of resources to help you on that path towards home ownership. Now, if you start looking at homes, you find a home you love and you make an offer, and let's say the offer gets accepted. Then we move to step 3, and that's called entering escrow. So that means the seller has accepted our offer, and it starts these next steps in home ownership. You're going to get a call from me within 24 hours of that acceptance to say, hey, congratulations, you're there, you're on your path. And then we're going to set up your follow-up consultation to review like your disclosures for your interest rate options, your out-of-pocket expense. Let's talk more about your assistance options if you elect to go that path. You'll also be responsible to deliver an earnest money deposit, which is usually 1 to 2% of your sales price, but needs to be received by the escrow company within 2 to 3 days of your accepted offer between you and the seller. Here's a slide that kind of shows you what the earnest money deposit looks like. So again, 1 to 2% of your purchase price. Now, what's important to understand is that deposit is held there in escrow while you take advantage of a time period called the contingency period. It allows you as a buyer to do your homework on the property. That would be to include getting things like the home appraised, right? Which we'll initiate that as the lender. Your realtor will help out with inspections of the property. And then as a lender, we'll get your loan approved. Usually that happens in the first 14 to 17 days of the contract period. Okay. Now, while all that's happening, we're doing things behind the scenes, like working on the processing of your loan. We're probably locking in your interest rate to make sure that's all protected. We're getting everything prepared for underwriting and getting everything submitted so we can initiate a loan approval. That loan approval gets delivered at step 6. It also takes you about 3/4 of the way through the process. By the time we get to step 5, at step 5, that also brings you to the end of your contingency period. So You probably have your appraisal has been back by that time. We want to make sure the appraisal supports the value, has a value that supports the purchase price. Get your inspections back for the house from your realtor. Also have your loan approval back from our underwriting team. So we're now 3/4 of the way through the process. If you feel comfortable in all those things that have taken place, then you're going to sign off on your contingency. Now that tells the seller that you're ready to move to the closing phase because you've done all your due diligence on the house and you feel really good about it, right? Just understand that once you sign off on your contingency, then you're kind of all in the transaction. So if you decide to cancel after signing off on your contingency, then you risk losing your deposit. At step 5, we're also going to deliver to you a final closing disclosure, which gives you a 3-day cooling off period before you do to the final kind of in-person process, because everything during our loan phase is all done through electronic signature. At step 6, you do have to sign documents in person with a public notary. That process will take about an hour to hour and a half. You then will also be responsible to deliver your final closing costs and down payment at that time. That's your final kind of wiring of funds. As a lender, we'll also wire in your funds for the financing. And then those monies get all reconciled with an escrow company to make sure that you've contributed what you're supposed to as a buyer and the seller's receiving the proceeds that they expected. Once all that stuff has been reconciled, then documents get recorded with the county recorder's office. They usually record a grant deed to transfer ownership to you guys, the new buyers, as well as the deed of trust to basically secure the loan. And once that's all confirmed, then you become the official owner of the home. That's like the best day because that's the day we get a chance to celebrate, right? Because now you become the official owner. I get a chance to make those calls at least once to twice, maybe 3 times a day. Best part of my day because it's a huge accomplishment. It's going to be the biggest, financial investment or purchase we make, right? So it's a big time for celebration. Okay, so that's kind of what our 6 steps of home buying look like. Let's talk a little bit about our resources and next steps. But before we do that, I want to answer one of our questions, which is, what is kind of so the question, and I think I talked a little bit about this, but the closing costs that we're referring to are going to be costs like your lender cost, title, escrow fees, maybe transfer taxes, inspection costs. Those are all going to be part of the closing costs, which are, like I said earlier, estimated around 2 to 3% of your purchase price, but it does depend on ultimately what you negotiate with the seller. All right, thanks for that question. So as we kind of move forward, if you're thinking about home ownership as a goal for you in this coming year or beyond, we'd encourage you get connected with us for a consultation. That starts with you completing a really simple online application. There's no fee for doing that. We do a soft credit check as I mentioned earlier. You then upload proof of income and assets, and then you use our scheduling system to schedule a consultation, whether it's on video or on phone. I would encourage you to do video because then we can do some screen sharing and kind of help design a plan together. Now, if you have some questions after tonight's class, like a scenario, maybe a credit question, we'd encourage you to do an introductory call with us. That's a 15-minute call with one of our team members just to help kind of take care of your situation and help kind of give you the tools that you need to take those next steps, which could perhaps be a consultation. All right, so this is what the framework of a consultation looks like. It's the kind of the basic framework. It is a free service we provide, designing kind of an affordable plan for you, taking a look at location of where you want to buy, talking about debt to income ratio, credit, making sure you understand all your options. It's an awesome experience. And again, it's about a 30-minute session that we do with our clients. And we also have some fantastic resources that are available to you via mobile. So our mobile tool is available for Android and Apple. You can actually start your full application there. You can follow the progress of your application. You can even do some different payment calculations all via mobile. So encourage you to check that out as an option to get your process started. I kind of mentioned earlier during our budgeting exercise our UC Irvine alumni discount. So we pass along a $750 credit towards your closing costs in working with our team. And we also have other partnerships across the country beyond our class that we teach 4 times a year for UCI alum. We also have other partnerships. So if you have friends, family, coworkers that you think would really benefit from a class like this, have them come check out some of our classes. They're free to attend, and you can find out a full list of our classes at mortgageeducate.com. As we're wrapping up tonight, we're right at the top of the hour, but I wanted to share with you all my contact information. So if you have some follow-up questions for me after tonight's class, feel free to message or call me. Love to be able to see where I can help you. Also would encourage you to kind of check out what our clients are saying about us online. I think our experiences with our clients are really important to us. We're going to help you on your most important kind of financial goal, which is home ownership, I would think. And so we have a lot of great experiences that are shared online and socially on YouTube, on our Instagram. We try to put out good content that's going to help support you on this journey. So I would encourage you to follow us there, J Meta Mortgage as well. I think that you'll find that really helpful. So that kind of takes us to the end of class. I know I got some questions kind of building up for me here. So I'm going to answer questions. I'd encourage you to stick with us. These questions might be helpful for you, but I'd love to be able to help provide you guys any resources as we're wrapping up to tonight's class. So the first question is, do you recommend buying directly from a builder? I think it just depends. I mean, I think everybody's situation is a little bit different. Builders are helping to, help, I guess, with the inventory challenges that we have in the market. I think with new home construction, I think it can be a great resource for you. Everybody loves kind of the shiny object of something brand new, but it also comes with it higher expenses. New home builds can have higher property taxes, potentially HOA fees, and then you have some kind of startup costs, right? You might have to put in your backyard, window coverings, that kind of stuff. So those are things you have to kind of think about when it comes to new construction. Let's see. So another question, which I might need some more help on this, is I've heard the term carry the papers when it comes to seller. What does that mean? So I think they're talking more about carryback. So it's more so called a seller carryback. That's when a seller is going to take the financing on. So if you decide to buy a house, the seller holds the financing. Those won't be compatible with first-time buyer programs, but you can certainly do it if it's something that works for you. Question on the income documents for the full 2-year taxes. Do all the pages have to be submitted? Yes. Yeah. So if you're filing your or sending over your federal tax returns, we'll need all schedules because there's different things that are in there that can impact our calculations. If I work for a foreign country and come back to buy a house in the U.S., would the tax process be any different? I don't know about the tax process. I know about the lending process. So if you work for a foreign country, it depends on where you're paying taxes. If you're paying taxes in the U.S., then we can use that income. If you're paying taxes in a foreign country but trying to buy here, it will probably be more of we have some foreign national programs that you can use. That could be an option. But the tax process, I would encourage you to talk to a tax advisor or something like that. Okay, good questions. I appreciate the group for asking all these questions. Anything else from the group? I know we're okay. I think we got it. Okay. If I missed anything, please don't hesitate to reach out to me. It was great getting a chance to connect with all of you in tonight's class. Hopefully you found, 2 or 3 takeaways that you can use towards your home buying goals. And again, we'd love to be a partner with you on that journey. So feel free to get connected with us. We have all our contact information for you available, and we'll get a chance hopefully to get connected with you in the near future. Have a wonderful night. Talk to you soon.